Hello, everyone, and welcome to another episode of Between Two Brokers. Today, we have Bill Payne, our mortgage guru and go-to guy, here to answer all of our questions about what's happening in the world of mortgage, the most exciting world.
So excited. Thank you for having me.
Especially
this time
now.
of year.
So first I want to start with kind of what's happening right now. We are the first week of October. This will come out probably mid-October, but I read an article in the Wall Street Journal. I know people are shopping rates. This is probably something that maybe this is a new thing for you. I don't know. But I had some agents come to me and they're like, well, I sent so-and-so to Bill and now they're shopping rates. And I'm like, well, they're shopping rates because they don't like what he told them about how much it costs to get a mortgage now. Right. So riff.
No, so interest rates are high. So why wouldn't you shop around and see if you can find something lower? What I found is everybody's at the same level.
Yeah.
It's unfortunate that they're high, but they're not going to stay at this level for next maybe a couple months, but they'll eventually decline. Mm-hmm. But it's a little like sticker shock.
Yeah.
Kind of when you see it, and it's so volatile. Like I could quote somebody on a Monday, and then 7 days later, a week later, send them a new quote, and the interest rate could be 0.25% higher. There've been times where they're like 0.5% higher. Mm-hmm. So nothing anybody can do to control that. It just is what it is. But it makes sense as a consumer, as a home buyer, that you want to get a second opinion. You do that if you go to a doctor. So
Let's, since we're kind of on that subject, let's talk about locking in.
Yep.
Explain like what it is, how long you have to do it, what happens once you do it and the rates go down or if the rates go up. Yeah,
that's tough. When you lock an interest rate, it cannot go up nor can it go down. That's the whole point behind the lock.
Right.
And you have to know when the closing date is going to occur because you got to make sure the interest rate is locked through that date. Interest rate locks last or go for 15-day increments. So you lock for 15 days, 30 days, 45 days, 60, and thereon. The trick, though, in this current market is week over week, interest rates are only increasing. So it's easy when you get a new contract in the door. I'm immediately suggesting, not forcing, but suggesting, let's go ahead and lock the interest rate because you're going to refinance within the next 12 to 24 months. Where it'll get tricky is once interest rates have leveled out and they start to decline, it could be disappointing that you lock an interest rate and then 30 days later it's lower. Lenders they do have the capability to float an interest rate down, but it's got to be a material change in the rate. And so the likelihood of that occurring is pretty slim. But every lender does give that caveat that, hey, if interest rates decline, we can float you down. Being honest, the reality is they never will. Mm-hmm. So interest rate locks are very important right now because interest rates are increasing. When you have a market that's stable or declining, you can kind of play the market to see if they decline by moving forward with the mortgage, getting the appraisal done, going through underwriting, and then trying to catch rates when they bottom out during that period between ratification and when they close.
And I mean, I know, I don't know how many mortgages I've gotten from you, Bill, too many. But when that was happening, how do you know when you think it's bottomed out? Like you would call me and you'd be like, hey, this is where rates are. I think we need to lock now. It's
experience and just reading a lot of nerdy stuff and trying to get opinions. Like if you read 10 articles, they'd all have slightly different opinions, but you can kind of meet in the middle of like, okay, this is generally what the expectation is for the next week or 2 weeks. Mm-hmm. That's part of it. The second is knowing what economic reports are being released by the government, mm-hmm. which ones are impactful and which ones are not. And then then at that point, you've got all the information you're going to be able to attain. Then at that point, it's kind of, it's risk reward, it's valuation. It's like playing cards. It's like playing dice. Mm. Is it worth it to take the risk that interest rates, in hope that interest rates decline by 1/8 or 1/4 versus the opposite of them increasing 1/8 and 1/4? And if that monthly payment is hugely impactful, it's never worth the risk. If you can heartache the potential of that payment increasing, yeah, then it may be worth holding out to see if interest rates decline. It always depends upon the client, what their situation is. So you can't, there's no one way to handle it. You just have to individually look at your client and determine what's the best for them.
Mm-hmm. See, people, it's important to get a smart lender who reads shit.
He reads articles, guys.
Yeah, pays attention.
Who does that?
Not just your bro that you like to get high with because you're trying to like give him some business. Does it cost anything? Although Bill might like to get high with you. I don't know. Does it cost anything to lock in?
No, it doesn't. It's a couple clicks of the button, so it's very simple. So yeah, there's no upfront fees that you have to pay.
Mm-hmm. So if you were thinking that rates might go down, would you just advise someone to lock in for just 15 days?
Okay, this is where it gets very complicated. Let's just say that your closing is 30 days out, you lock for 15 days. Therefore, the rate's going to expire prior to you closing. It's rare that you would ever kind of follow through with this way of approaching it. But then at that point, once you hit the rate lock expiration, you always have the possibility of extending the rate lock, but that comes at a cost. Or if it expires, you just let it expire, mm-hmm. and then you could relock at the current market. It is very rare that that's the right approach. It is a possibility, but it's not one that I've ever, maybe once or twice, utilized.
Yeah, sounds complicated. Just leave it up to Bill.
So what are you seeing? I haven't really even had a ton of buyers recently, or they've all been cash. But like, mm-hmm. who is getting mortgages, and what kind of mortgages
First-time
are they
home buyers.
getting? Okay,
that is the majority of my business right now.
Wow,
which is great because they're going to buy another house in 4 to 10 years. Mm-hmm. Also, really fun to work with first-time home buyers, but. They're generally right now, interest rates are in the high 7s, low 8s. Mm-hmm. And for a first-time home buyer, that's expensive when you're looking in our market and our price points.
Right.
But also go through the practice of saying, okay, if this interest rate were 1% less or 2% less, this is what it does to the monthly payment. Because I feel confident we will see rates 1 or maybe hopefully 2% lower mm-hmm. in the near future. And so for first-time home buyers, there's always the uneasiness because, wow, I'm a homeowner and I got to make this monthly payment. But if you go through this drill of looking at different scenarios and helping them understand, like, their earning power, because they're usually younger, will exponentially grow year after year. What feels uncomfortable today may feel very simple and easy to pay 2 or 3 years down the road. Mm-hmm. So that's something that when I was early on in my career, I've routinely worked with first-time home buyers, and it's conversations that I'm having now a lot more than I used to, say, like 5-6 years ago.
Yeah.
To your point, because so many people buying second homes, investment properties here in the area are just purely paying cash.
Mm-hmm. How much are they putting down?
5 to 15%.
Wow.
Yeah.
Yeah.
Is anyone doing ARMs right now?
Jumbos, yes. For a conventional loan, a Fannie Mae, Freddie Mac, no, because of the inverted yield curve.
Oh, here he goes again with the inverted yield curve.
The ARMs just aren't worth it. Like maybe they're an 1/8 or 1/4% lower than a 30-year fix.
Explain in layman's terms why it is worth it on a jumbo.
Because the difference in the interest rate's material. It'll be like 0.5% to maybe 1% these days. Mm-hmm. And
a jumbo in Charleston is over what dollar?
$726,200. Mm-hmm. So if you got $1 million loan amount, you can get a 1% lower interest rate by going with a 7-year ARM. In my opinion, that makes sense because I'm working under the premise that interest rates will be lower in 2 to 3 years, and then they can refinance to a 30-year fixed.
Yep.
Another thing I wanted to ask you about, because this has come up quite a lot in the last 6 months, can we squash the idea that you're going to be able to assume somebody's 3% mortgage.
Totally.
If I am going to sell my house, so the problem is that assumable loans are typically only issued by the VA and FHA.
100%. Yep.
So number one, that's generally like a lower price point. A lot of the people that were buying them were first-time home buyers for the FHA years and years ago. I mean, it's just not like any homeowner can give you their 3% interest rate.
That's exactly right. So first, the loan has to be assumable, step one. Step two is, let's just say the house being sold is purchase price $500,000. The seller bought that home 2, 3, 5, 6 years prior ago, and so they probably only owe like $250,000. So you got a gap right there of $250,000, $300,000. So just to assume that loan, that buyer has to bridge that gap. Well, what are you going to do that with? Cash or a second mortgage that's going to be at a higher interest rate? So then you blend those two interest rates together, and it may not work in the first place, and second, it may not look that pretty.
Is there a way to find out if somebody has like publicly to search like VA or FHA loans that people have?
Yes, I think that information is out there. I don't know where to find it, but my guess, because the VA is kind of an open book, usually I bet you can find that stuff.
Okay.
But the whole idea, I've seen, it was in 2017 or 18, was the only time, and I've been doing this since 2005, that I saw someone successfully assume a VA mortgage.
Right.
So it's rare.
Right.
Are you seeing anybody refinance right now? I'm sure not a lot, but maybe someone whose arm is coming up for expiration, or?
No, only people going through divorce.
Yeah.
Because you got to get the other spouse or ex-spouse off title in the mortgage. That's it. So
as if it didn't sting enough.
I know it.
I know. Gnarly. Just stay together, right?
Yeah,
Or just
we got
don't
no
get
advice on
married.
that one. Yeah.
Right? Okay, any more that you want to add about what's happening in the mortgage markets today, October 2023?
Let me flip a question back to y'all.
Yeah.
Home values, are they still increasing all through I'll call the Charleston bubble, like within 526, or is Folly Beach or Isle of Palms, have they kind of become stagnant?
Yeah, that's been impacted for sure.
Yeah.
Because of the short term?
Yes.
Okay.
So
Yep.
Bill is referring to some changes that are about to be voted on IOP, Isle of Palms, and have been changed on Folly Beach that affect short-term rentals. So they're very restrictive. I'm not going to get into the details, but if people don't have the flexibility to do it, then that impacts values a lot.
Yeah. Folly Beach has got somewhere between like 40 and 50 active listings right now, and they're just sitting because it's such a vacation rental market. That, and they put this law into effect in February, and it's really hurt business out there.
It caught everybody off guard?
Yeah.
Okay.
Yeah. No one thought that this was going to pass, and it did.
Okay.
And now Isle of Palms is looking at the same thing, but they're actually going to restrict it, consider anything a short-term rental that's rented less than 3 months, which is not a short period of time.
Okay. I brought that up because I've worked with and have been working with so many folks moving or living not in the area but looking to buy second homes, specifically Folly and Isle of Palms. And the high rising interest rates made them pause.
Yeah.
But now with this type of stuff, I mean, I'm still talking to them. They're still checking in with me, but I don't think they're willing to even make a leap at this point.
Yeah, that's what I'm experiencing as well with my listing on Folly. Is that it's just not only the rising interest rates, it's the rising cost to insure something that's on the coast.
Right, totally.
It's really expensive.
So you see these things all fall in place: high rates, high insurance costs, the rules surrounding short-term rentals, and that puts a pause, at least on those barrier islands, as far as the transactions. And so I think that with what the Fed has said they're going to do is to slow inflation, which means slow the economy down. We won't see interest rates start, or now with things like that happening, we will see interest rates start to slowly trend downward. Like we're finally hitting the crest. And I know this doesn't help us all from a real estate standpoint, but at least mortgage interest rates can see the light at the end of the tunnel.
Oh, we should end on that silver lining.
Sounds perfect. Well, thank you so much, Bill, for telling us what's going on in the mortgage markets. Don't forget to call Bill Payne, 843-532-1392. Oh, my gosh, I almost messed it up.
She went out last night.
I did. So anyway, don't forget to rate, review, and subscribe, and tune in next time. Follow us at Between Two Brokers and at Smith Spencer Real Estate. See you next time.